In this video, we'll look at the Income Statement 1. Income Statement 1 calculates the gross profit and gross loss made by a business from the goods or services sold in a trading period, which is usually 1 year. Finding out if a business has made a gross profit or a gross loss is calculated by working out the difference between the sales and the cost of sales, which is what we'll be doing in this video. We're going to break down the Income Statement 1 for Coffee Co Ltd, an independent coffee shop. We'll walk it through step by step, explaining each section with real figures so you can understand how to calculate an income statement. First up is sales, which is the total revenue from selling coffee, food and other products over the year in the cafe. In this case, Coffee Co made 400,000 in sales during the year. Next, we subtract sales returns, which is the returns or refunds given to customers. For Coffee Co, the sales returned amounted to €5,000. Sales returns are subtracted from sales because the company didn't keep this money, it was refunded to the customers. So our coffee shop made 400,000 in sales and we had 5,000 in sales returns. As we said, we didn't keep the sales returns money, so the actual net sales as a result of this are 395,000. The next part of the income statement is less cost of sales. So a company making €395,000 in sales, you'd imagine, are making huge profits, but that may not always be the case. In order to make that amount of sales, they would have to spend a lot of money on things like raw materials, packaging and labour that go directly into producing the goods. This step is where we account for how much it costs to produce the coffee and other items that were sold. So we're trying to figure out how much it costs the coffee shop to enable them to make 395,000 in sales. Say for example, if you set up a mini business in a school selling hats for €10. If you sold 100 hats, that would mean your sales would be €1,000. This doesn't mean you made €1,000 in profit. You would have had to have bought the hats and paid shipping, and this might have cost you, we'll say, €500. So already your profit's coming down when you're accounting for the cost of sales. This is essentially what we're doing here. So we'll start off with opening stock, which is the amount of stock at the beginning of the year. For Coffee Co, this is 32,000. So this could be all the food ingredients to make the food, coffee beans from the previous year, coffee cups, plastic straws, napkins, etc. All stock that the coffee shop have that's already available and left over from the previous year. Then we have purchases, which is the cost of new stock brought in during the year. In this case, Coffee Co bought 180,000 worth of supplies, which would be items like coffee beans, more plastic cups, food ingredients, and basically anything that they bought that could be used to make a sale. Next is Carriage Inwards, which is the delivery cost of getting stock, and this amounted to €1,200. So when the coffee shop bought supplies from their supplier, the supplier would have charged them a delivery fee to deliver the products. So to give this a quick recap, the coffee shop started out with €32,000 worth of coffee beans and cups, etc. And throughout the year, they bought 180,000 worth of new supplies to keep the coffee shop running, and on top of that, they paid €1,200 in delivery fees to get all these items delivered to their coffee shop. Now we calculate the cost of goods available for sale, which is the total stock you have available to sell during the year. All we do here is we add the opening stock, purchases and Carriage Inwards, which amounts to €213,200, and this is the amount of goods the coffee shop has available for sale. Next, what we do is subtract closing stock, which is the value of the stock left at the end of the year. For Coffee Co, this is €40,000. What this means is by the end of the year, Coffee Co still had 40,000 worth of unsold stock. So that could be coffee beans still on their shelves, coffee cups and other supplies. This closing stock would be the coffee's opening stock for the following year. Next, we have cost of sales. This is the cost of the goods that were actually sold during the year. It's calculated by taking cost of goods available for sale and subtracting the closing stock. We subtract the closing stock because we didn't sell this during the current year. So your total cost for the goods you actually sold during the year is €173,200, which is our cost of sales. Finally, we have gross profit, which is what's left over after subtracting the cost of sales from net sales. It shows how much money the company made before paying for other expenses like rent, wages or utilities. So here we are taking the coffee shop's net sales of 395,000, which we already calculated, which is the amount of money they took in over the course of the year selling coffees, and we subtract our cost of sales figure, which is €173,200, which is what it cost the coffee shop to produce those sales figures, and this leaves us with a gross profit of €221,800. €221,800 is the money the coffee shop made. However, this is not just pure profit into the coffee shop's bank account. We didn't factor in things like paying for rent, employees' wages, electricity, internet, etc. And this is exactly what the income statement 2 does, and there will be another video on that will follow this.